Sure enough, the Bank of Canada is reducing borrowing costs by 1/4 of a percentage point, as the economists had expected, bringing its core rate down to 2.25%. And excess capacity expected to persist, according to the Bank of Canada. Of course, that means unused factories and people in the economy are not being used to the full extent. Tiff Macklem, the head of the bank, saying that tariffs are imposing, quote, severe effects on steel, aluminum, autos, and lumber, although he acknowledges the uncertainty out there. He says range of possible outcomes wider than usual. He expects opposing pressures on CPI to keep it nearer 2%. Well, that would be a pretty benign interest rate within the bank's target level. Macklem is trying to quantify the cost of Trump's tariff war. He says that the level of Canadian GDP will be 1.5% lower by the end of next year relative to the pre-tariff outlook. So there's an idea of the cost Trump's administration has imposed on Canada. Macklem also says negative impacts from U.S. tariffs are becoming more evident. And he says weakness in the Canada economy marks, quote, a structural transition. I'm not sure what he's getting at specifically there, but Macklem also looking for very modest growth for the rest of 2025. Let's get more now from Warren Lovely. He's standing by, Managing Director and Chief Rates and Public Sector Strategist at National Bank Financial. Warren, I know you've had precisely no time to analyze the comments there, but as expected, bringing down borrowing costs by 25 basis points.
Yeah, and Andy, going back-to-back since restarting this easing cycle last month. Back-to-back sounds familiar maybe to some. The Jays did it in the early 1990s, but there's nothing to cheer about here. I think we're lowering interest rates because the economy is under immense strain. And you pointed out what Macklem and Governing Council are talking about, slack in the economy, underutilized resources, whether that's physical capital or human capital, and just a continued swirl of geopolitical uncertainty. And it argues for taking out some interest rate insurance here and moving the interest rates lower to what is now the lower end of the notional neutral bound.
Just give us that, just explain that bit of jargon there again. Yeah. What do you mean by that? Sorry.
Yeah, so the Bank of Canada is setting one interest rate, the overnight target rate, and this is very imprecise, but they have a range that they consider to be a neutral rate of interest, where it's not really exerting undue strain or support for the economy. And that range is thought to be 2.25%, which is what we're at now, to 3.25%. So what you can see in moving lower here in back-to-back meetings, we've gone from 2.75% to 2.25% in two meetings. We're now at this kind of neutral, but at the low end of the neutral range. We're basically almost needing to provide stimulus, monetary stimulus for the economy. And I think that's appropriate because look around. The labor market is weak. The export outlook continues to be challenged. We're suffering from a death of 1,000 sectoral tariff cuts in our industrial sector. This is an economy that needs support.
They're pretty... Well, they're pretty lukewarm on the growth prospects. They're cutting the GDP growth forecast to just 1.2% this year and only 1.1% next year. So that's pretty close to zero growth. I know it's not zero, but it's still pretty lackluster.
Yeah, lackluster is exactly how I would characterize Canadian prospects here until we get some certainty on trade, which, to be honest, I'm not sure we're going to get in the near term, notwithstanding efforts over in Asia to try and secure, new markets for Canadian exporters, to try to mend fences with the U.S. I'm not exactly holding my breath. And that uncertainty there just creates those lackluster conditions, Andy, that you're talking about. It really just saps confidence on the part of businesses that might otherwise invest, and on the part of consumers that might otherwise have made a large purchase, maybe bought a home. They just pull back. And as you pull back, so does GDP growth, so does hiring. So expect pretty limited growth. Expect labor market weakness to continue here. And as a result, the Bank of Canada might not be done.
I know this is a very broad question, but should Canada just consider competitive devaluation of the currency? Just keep driving down interest rates to boost our exports? I know it's not simple because we bring in so many inputs.
Well, to some extent, the market's sort of taking us to a cheaper valuation for the Canadian dollar anyway. Mm-hmm. You can see this when you have concerns around global economic growth in a trade protectionist environment. Commodity prices get set lower. The Canadian dollar is like effectively a petrocurrency. We trade on oil and commodities. So some of the concerns around trade war and lower growth, concerns about growth in China have produced lower commodities and a cheaper Canadian dollar. So to some extent, has the Canadian dollar devalued enough? It's not clear. I think what we can say definitively, Andrew, is that some form of stimulus is needed for an underperforming economy. You can get that through lower interest rates. You can get that through fiscal stimulus. And I guess to some extent, we'll be eyeing very closely the federal budget next Tuesday.
And for sure, we're expecting a massive deficit, tens of billions of dollars, partly because of this defense spending that we're going to be rushing into, along with European countries.
Yeah, an enlarged defense expenditure seems to be the cost of doing business with the U.S. administration. We need to make more commitments there. We also seemingly can't retaliate in terms of having our own tariffs, so that robs the government of some tariff revenue. Right. And I guess we can't run offending ads either, so the president tells us. So, there's a few things that we're learning in terms of how we can and cannot engage with the United States. But the federal budget is really meant to be transformative. I don't think it's an overstatement to say this is one of the more important federal fiscal blueprints that we've seen in a generation, probably since we started to work our way back from the financial abyss in the mid-1990s. So there's a lot riding on this budget on Tuesday. I would caution viewers that in terms of looking for real quick, immediate fiscal impulse, a whole bunch of growth thrown off by the federal budget, we might need to recalibrate our expectations. All that billions of deficits that you mentioned, Andy, will get us something, but it might come a little bit longer. It might take longer to show up. And as a result, in the short term, the Bank of Canada needs to be the driver of stimulus for this underperforming economy.
And Macklem, once again, though, at pains to say, I can't fix the damage from the trade war with interest rates.
Yeah, I mean, look, we're all in this together is effectively, I think, what the governor's trying to say. And I think most economists, strategists, most viewers would appreciate that a central bank maybe isn't perfectly positioned, to lead on a geopolitical fight and a trade war. There is clearly sectoral damage. There's damage to businesses, to workers. Governments need to be reacting to that, protecting those vulnerable sectors. They also need to be putting in place conditions to grow the economy longer term. Interest rates, lower interest rates can help, but we really need to have a concerted effort here on the part of monetary and fiscal policy, government and central bankers to help get us out of this mess that we're currently in.
Now, what about this? I know it's a cliche now, but boosting per capita productivity. It's a complicated question, but presumably there'll be some painful adjustments. What do you think are some of the unpleasant things we as a country will have to do?
Well, again, in the absence of actually reading through the monetary policy report, I was struck by the structural transformation and structural change in the economy that the Bank of Canada is flagging here. To some extent, we are in a structural productivity crisis. And by that, I mean, there really just hasn't been much to show, really almost nothing to show for the last 1, 2, 5, 10 years of effort here. So we've really been a kind of a hamster in a wheel in terms of generating more output per worker hour. That's a problem because that's how you measure long-term standard of living. We really need to get productivity growth started. That means lower regulation. It maybe means reassessing the tax code. It means trying to get major projects not just over the finish line, but just started generally. There's a lot to be done. The federal budget, again, is meant to give us some clarity and a bit of a vision statement and a roadmap on this. But let's be honest here. You don't fix a multi-year, maybe decade-long productivity crisis with one silver bullet, and you certainly don't do it in 1 or 2 quarters. So let's be a little patient here.
John Manley, the former Deputy Prime Minister, has an op-ed in the Globe saying we have this great tax incentive for investors in resources, the flow-through shares. Why can't we do that in tech too? Should we maybe remove some of the incentives for resources and move that over to innovative, technological, high-tech manufacturing? Because, I mean, the population, as you know, is in Ontario and Quebec, and those are not resource economies.
Why can't we do both? I guess, Andy, is what I'd say. Look, Canada's in the resource business, so I get that there's a lot of people in Ontario and Quebec. But if you look at, what is driving growth, you look at our what we have available to export. At least currently, it's resource-centric. So we really do need to have a resource strategy. I think we need to have a high-tech strategy as well. Why pick one or the other? I think we need to be doing both. We're in the resource business. We're really in common earths, if you'll forgive a bit of an expression. So let's embrace it. Let's own that. Let's generate some economic activity, jobs, investment, income, profits, you name it. But let's also be looking for those next drivers of growth over the medium and longer term. And certainly tech is right at the top of everyone's list. We have a pretty skilled workforce. We could have better regulation. We could have better tax incentives to give us a better chance to compete there and to drive growth longer term.
Do you think there would ever be a political appetite in Canada for the type of cuts pushed forward by Javier Milei in Argentina, radical cuts in government?
I don't think this is the time to be considering radical cuts to government, because we really have an economy, again, to be frank, that's on government life support. The private sector has detached, I think for obvious reasons. They don't have confidence in Canada right now, and that's understandable. We don't know what type of rules of engagement we're going to have with our largest trading partner. We haven't been able to diversify. We're dependent on the U.S., and that situation is highly uncertain. So it's entirely understandable that the private sector has said, hey, I'm not sure that this is a good time to be looking at Canada. It puts the ball in government's court. It puts the ball back in the central bank's court to be driving growth. So in the short term, government cutbacks probably not that appropriate, but let's be efficient. Let's get something for our investments.
Warren, thank you very much. Warren Lovely of National Bank Financial.